Hey, I'm Ben from Monogram, and today we're going to do a Monogram valuation of Chubb Ltd. So stick around to hear what I think of this company. So first of all, we've got Chubb Ltd. The ticker is CB and the current price is $191.12. The sector is financial services and this is an insurance company. And over here we have the items from the balance sheet that I find most important in evaluation. We have total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and shares outstanding. And all of these figures will come into play later in the valuation or at some point in the background. So pay attention to those. Now over here we have a chart showing the earnings per share diluted in blue and the dividends per share in red over the last 30 years. So you can see we've had a couple of dips. We had one at the recession in the tech bubble burst. And then we had a little bit of a dip around the time of the financial crisis and a little bit after that. But pretty much since then, this one has been very solid. And the dividend has grown very well. Let's look at the details here. We have the earnings per share diluted here. And you can see that, yeah, that has grown really well. We had negative earnings in 2001 and all the way back in 1994, but none other than that in the last 30 years. Then we have earnings per share Monogram. That is a weighted average of the last 5 years of earnings, putting the most weight on the current year and the least weight on 5 years ago. And we do that to kind of smooth out the business cycle a bit more. So you can see where it has gone way up, say like in 2013, there's a big jump from 2012 to 13. That wasn't quite as big on the earnings per share Monogram side. That is much smoother on that business cycle so that you can see long-term trends much easier with that data. Dividends, here we have the data on the dividends per share. It is currently paying about $3.29 per share, and that dividend growth is pretty solid, but there have been a couple years where it has dropped. Now we have it has paid a dividend for a very long time, but of course, once again, the dividend has not grown quite as consistently as we would like to see. So that is one thing to keep in mind. That dividend yield typically is between 1 and about 2.5%. And the dividend payout ratio stays at a little bit less than 40%. So they are reinvesting a lot of their earnings to go into growing the company. Now let us take a look at the valuation. Stage 1, is this company suitable for the defensive investor or the enterprising investor? And keep in mind, the defensive investor is one who is not willing to do extensive research into a given company. So they have very stringent requirements. So let's take a look at those. The company has to pass 6 out of the following 7 tests. First, we have the market cap has to be over $2 billion. It easily passes that. The current ratio has to be over 2. It is 8.67 here. It has to have a positive earnings per share for 10 years. Passes that. It has to pay a dividend for 10 straight years. It passes that. It has to have earnings growth of over 33% in the last 10 years using 3-year averages at the beginning and end. And we have a growth rate of 41% here. So that one passes that test as well. It has to have a price to earnings ratio under 20, and that is 12.73 here. Of course, that is using the normalized earnings per share figure. So we have the PEMG, as I call it here. Then it has to have a price to book ratio under 2.5, which it does at 1.49. That passes there. And if you've been keeping count, we have 7 out of 7 for the defensive investor. So yes, it is suitable. Now, the enterprising investor is one who is willing to do more research into an individual company, so the tests aren't quite as stringent. And also, if it is suitable for the defensive investor, then it is suitable by default for the enterprising investor as well. But let's take a look at these tests just for the sake of going through them. The current ratio has to be over 1.5. It passes that. The debt to net current assets has to be under 1.1. It passes that. It has to pay it has to have positive earnings for 5 straight years. Passes that. It pays a dividend, so it passes the next one. And it just has to have earnings per share greater than 5 years ago. It passes that as well. So a perfect score all around for both the defensive and enterprising investors. Now, if you are enjoying this video, please take a moment to like the video, subscribe to my channel, and download the free valuation calculator, the link to which you can find in the comments below and in the video description. And stage 2, we have a determination of intrinsic value. And of course, the value is different from the price. Remember, the price is what the market is willing to pay. The intrinsic value is what the company is actually worth. And to calculate that intrinsic value, we use the modern Graham value formula, which is taken from Benjamin Graham's classic book, The Intelligent Investor. And that formula is value equals earnings per share times 8.5 plus 2 times the growth rate. And of course, I have replaced that earnings per share with the normalized earnings that I use, and that is why I call it the modern Graham value formula. Now, we have 2 variables to calculate. We have earnings per share modern Graham and growth. So let's get to it. Earnings per share modern Graham, again, is a 5-year weighted average, putting the most weight on the current year and the least on 5 years ago. So we get an earnings per share of 1502. We put that here and we take the figure from 5 years ago, 8.9, and we calculate a total growth of 68.8%. Divide that by 5 and we get an average annual growth of 13.76%. We put in a safety margin here because growth is such a key variable to this formula that you don't want to overestimate. And so we reduce it here to make sure that we have a conservative valuation here. And then that is our growth estimate of 10.32%. We put those figures into the formula and we get a valuation of $437.60, which based on this very handy chart over here, you can see the value is significantly higher than the current price. And according to that, the value is, or the company is undervalued at the current price of $191.12. That is only 43% of the intrinsic value. Now, a couple of other things to note. We have the modern Graham value based on 3% growth is $217, and on 0% growth, it is $127. So if you take the price and put it in for value and then solve for growth, you get a market implied growth rate of 2.11%. And so another way of looking at this formula is if you believe the company will grow more than that in perpetuity, then the company would be undervalued. If you think it will grow less than that, then it would be overvalued. Now, coming down here, we have the modern Graham grade, which is another way to score a company so that you can compare it to other potential investment opportunities across different industries. We have 2 points for investor suitability. Remember, it's suitable for the defensive investor. It gets 1 point for being undervalued, 1 point for trading below its Graham number, which we'll talk about a little bit more in a moment, 1 point for having long-term dividend growth, and half a point for trading below its industry average, for a total score of 5.5, which on this chart comes to an A+ grade, which is very good. Now, stage 3, we have further research. And we have net current asset value. That is a floor to your value. And here it doesn't matter because it comes to a negative amount. So really your floor is $0. But it's good to have that and consider that as well. The Graham number formula is taken from somebody took the defensive investor requirements and turned them into a formula at some point to have a way of calculating that and having a number on those requirements. So you have another way of looking at it. And with that, we come to a Graham number of 230.08, which again is more than the current price. And so it is trading below its Graham number. A couple other things. The price to earnings ratio is 12.73. The current ratio is 8.67. The PB ratio is 1.49. The dividend yield is 1.76. And this is telling me that it has had 29 straight years of dividend growth, which is a little bit weird because in our overview, we did have a couple years here where it seemed that they cut that dividend. So that is an interesting issue. There were like interesting thing. I'm not quite sure which one the data is correct on, so I apologize there. But we have the share buyback ratios. You can see 10 years they were issuing stock, and then lately they've been buying it back. There have been no insider buys in the last 3 months. Now, stage 4 is to look at the chart and do a little bit of technical analysis. Now, remember, you never want to use technical analysis as your basis for your valuation, but it can be useful when you're trying to get the right entry point. And so once you've decided that the company is suitable for your own portfolio, then you might want to look at the chart and pay attention to it to try to find the right time to come in. And a couple of things that I look for are especially down, or like I watch the moving averages. And of course, when it is trading below, like this red line is the exponential moving average for, I think, about 50 days. Then if it's trading below that, it's kind of on a downward trend. If it starts trading above that, then it would seem to be on an upward trend. And that can be reinforced as well by what is down here, the RSI. And actually, let me change this real quick. Okay, this is the RSI graph that I want to have here. We have the purple is the current RSI. That's the relative strength index, and that can show the momentum in the stock. And if it drops below this green dotted line, that indicates that it is oversold. And if it goes above the red line, it is overbought. And so you can pay attention to that and know when the market might turn around. These other lines are moving averages that I have put into this chart so that I can also see the trend in the RSI as well. And so you can see that it was moving up there. That was a good time to get in around here when that was starting to creep back up. And over here now, it is kind of stagnant, it would seem. And that is reflective in the chart as well. And so what I would be watching for is for this to come back down. And it came down here for a little bit. And then it came back up, it bounced up a tiny bit, and it's sticking around. It's gone up and down the moving average. So I would be paying attention to that and watching that RSI to see when it might start to turn around, and then that would be your good entry point. But anyway, that is all that I look at. I hope you found this useful. Be sure to click on the video on the screen now. It will take you to another valuation that you will find useful. Thanks for watching, and I will catch you next time. Take care.